Hi, I'm Glen Byrne, a finance broker with 6 Point Finance. Today I'm going to talk to you about the differences between variable interest rates and fixed interest rates for housing loans. When it comes to interest rates, you will have heard in the news that the Reserve Bank will drop in interest rates, and generally soon after the banks will reduce their rate. The rates they reduce and what they're talking about are their variable interest rates. What you won't see advertised is what happens with the fixed rates, because fixed interest rates aren't necessarily linked directly to the Reserve Bank announcements. The bank's economists are the ones who decide what fixed rates the banks are going to charge. You quite often get asked as a broker, which is the best rate? And the reality is there's no one correct answer for that, because the correct rate is going to vary from each individual client with their own individual circumstances. But I thought I'd talk to you about what each means and what are the advantages and disadvantages with each of these types of interest rates. The thing to understand with variable interest rates is they are variable. So as interest rates go down, your interest rate goes down and so does your repayment. Conversely, when interest rates go up, so do your repayments. What they do obtain or provide for you is the flexibility to pay as much off as a loan as you like without penalty. So this can be a great advantage to you. They also offer some other features and benefits, such as being able to redraw your advance payments if in need of cash in the future, as well as having other advantages such as having your salary credited direct to your loan, which can save on your interest. So if you think of variable, the word you should look for is flexibility. Now when you think of a fixed rate loan, the term you should think about there is certainty. What a fixed rate loan is, it provides you with certainty of what your repayments will be during that fixed rate period. Fixed rate loans generally go from anywhere between 1 to 5 years. However, some lenders offer them up to 10 years. What happens during a fixed rate loan is during the fixed rate period, you'll know exactly what your repayments are during the full term of that fixed rate period. So regardless of what happens with the interest rates, you'll have certainty in knowing what your repayments will be. This can give comfort, particularly in times where there's some economic uncertainty, or where a client is maybe unsure as to what's happening with their income. So they can be a great option. The disadvantage with a fixed rate loan is that lenders generally limit the amount of additional payments you can make during that fixed rate period. Now each lender is again different, but most are limited to somewhere between $5,000 or $10,000 over and above your normal minimum repayments during that fixed rate period, or per annum. If you have to break that fixed rate loan during that fixed rate period, the bank will charge you a fee. Now how much that fee is will depend on how far you have to go on the remaining part of your fixed rate period. So that could end up being only a couple of $100, or it could be several $1,000s. So when you're deciding on a fixed rate loan, you need to be aware of that from the outset, because that may have an impact on what you do in the future. Currently we're in a very low interest rate environment, and a lot of people are wondering where things are happening and considering when they should consider potentially fixing their loan. The reality is that when the Reserve Bank decides that they're going to increase interest rates, it doesn't mean that the fixed rates won't have already increased because the bank's economists have decided to make that decision. So if you're contemplating fixing the interest rate, I wouldn't just wait until you hear the Reserve Bank increase the interest rate, because you may have already missed the boat and the rates have already increased. So it's really important that you talk to your broker on a regular basis about how you feel about your interest rates, so that they can best determine the most appropriate rate and structure for you to put you in the best position possible. As I said at the outset, there's no one right, so there's no one right loan for the individual. You've just got to understand what the differences are, talk with your broker through your individual circumstance, and then find the best solution for yourself. In some occasions, it may be having a split loan facility where you have part fixed and part variable, where you have the flexibility for part of your debt, but also the certainty with another part of your debt. When you're next looking to borrow, give us a call. We'd be happy to talk about what options may be available for you and what are most appropriate from all the lenders that are available. Thanks for watching today, and have a great day.